As we head toward the end of the year, our thoughts go back to December, where the market fell 18% all of a sudden and then bounced back in January. Still, a lot of people wondering, will that happen again? Joining us now is Tim Quast. He is president of the market analytics firm ModernIR, a firm that helps companies look at their investor relations from a market structure perspective. Tim, we appreciate you joining us. I read a great article in Market Watch the other day where you were quoted, so I think it's a really underreported story that needs to get more attention, and that is perhaps this growing concern about lack of liquidity in the market. Of course, market firms will say it's not a problem. You beg to differ.
Yeah, Brian, good to see you. Yes, if you look at the data, which we should be doing as participants in the market, as the capitalization of the equity market has gone up, and up, the liquidity measures have gone down, down, and down. And I think it's important for us to define what we mean by liquidity. So we think of liquidity to mean the amount of something you can buy before the price changes. So under current market rules, if brokers are required to post a minimum 100 shares to buy or sell, the bid or the offer. And yet, if you look at the S&P 500, and this was the point that I raised in this Market Watch piece, that the S&P 500 trades at 135 share increments, which means it's barely the minimum. And if you look underneath that, the data from the SEC's Midas system shows that almost half of all trades are less than 100 shares, odd lot trades. So then you juxtapose that with the size of BlackRock, Vanguard, and State Street, put them together, 15 trillion in assets, and you have to ask, can 15 trillion of assets move efficiently 135 shares at a time?
We have a graphic that we showed for our viewers on listening, or rather listening on the radio. They can't see it. It's a great graphic. It shows basically the percentage of trades as a percent of market capitalization going back to 2009 and 2010. And that just continues to fall. In other words, we're just not seeing the volume out there. You just talked about how the actual sizes of the trades are getting smaller as well. Is that what you think sort of happened in December of last year? And maybe that's in some ways a taste of things to come?
Well, yes, I think so. And here's how to know. If you looked at the fund flow data in the fourth quarter of 2018, about $360 billion left actively managed portfolios, but the same figure shifted to ETFs, about $360 billion. So there was a net zero change in the amount of assets under management. So how did the market go down 20%? And the answer has to be a supply chain issue. I like to say that if you use an analogy, we go to the store for a T-shirt, and if it's not on the rack, we know that we have to wait for them to get the correct size. Well, in the stock market, we just expect that somehow there will always be a correctly sized T-shirt on the rack. Well, what if there isn't, right? What if, and in fact, the data would already tell us that's the case. If half the trades in the market aren't at the minimum bid and offer, we know there is insufficient supply. So then, if people do sell, then you can end up with a fire sale because the absence of supply will drive the price down sharper than it would otherwise.
Now, there are circuit breakers. I mean, in the market, there are protections against stocks falling, as they'll hit the circuit breaker, they'll stop. I mean, the market does have protection.
Well, yes and no. We could take recent examples here where stocks have moved sharply. There was, you take Biogen. Biogen jumped more than 50% in a day. How's that possible? Circuit breakers are supposed to kick in anytime a stock moves more than 10% from its average prices in about 5 minutes. I had an exchange with the SEC just this week about a particular stock that did that in a minute. Its price changed 12% in a minute.
Wow.
And I said, well, how come it didn't? Why did the lull, the limit up, limit down, not kick in? And they said the band adjusted halfway through the move. Well, it clearly tells us we can't rely on those things.
Also, can we rely on the ETF and index fund industry? And I'm not picking on them as well, but they've adopted this term passive. We hear it. I'm passively investing. I don't think that's a good term because I know a lot of funds that are now actively trading ETFs. Yes, they're passive in a sense where they're constructed, and then you just leave it alone and you buy what's already been built. But let's be clear. ETFs are beginning to be traded like stocks and fast.
Well, absolutely. And you're a brave man to take this on, Brian, because I've done it too. I've poked at the unique features of ETFs that introduce arbitrage into the market. They, by definition, have to have an arbitrage mechanism. So here's how ETFs work. So they are created in large blocks off market, 50,000 shares typically. No competition, stable price. Remember, definition of liquidity is how much of something you can buy before the price changes. Well, if you can get 50,000 shares of exchange-traded fund shares and then turn around and shred it into the Brownian motion, the random frantic movement of the equity market, what happens to the market? Well, if ETFs are a small part of the market, it's not a big deal. But as they become 50% of market volume, ETFs directly are 50% of market volume, then the focus of the market shifts to how prices of ETFs and the underlying composite stocks change. And if you're an arbitrager and you can trade 50 shares instead of 100, it means your value at risk to change the price of one or the other is half what it necessarily should be. And that becomes the focus of the market. It's not a big deal unless ETFs are huge. Well, how many ETF shares have been created in 2019? Through August, this is Investment Company Institute data, $2.6 trillion of ETF shares have been created and redeemed against inflows of only $36 billion. What's going on? Well, we've devolved the market into the pursuit of how ETFs move relative to stocks. Are ETFs above the stocks? Then short them and buy the stocks, and vice versa. Wow. And that now, by our measures, is 87% of market volume. And everybody's looking at Trump tweets and trade fears and economic data, and they're missing the fact that what is really driving the market is this spread trade.